Hello friends, today we are going to discuss about second most important risk facing the banks after the credit risk, that is the market risk. And as the name itself suggests, the market risk comes because the banks or financial institutions are functioning in the market and they have activity in the market. When we say the market, it basically talks about trading activity. And we have seen there was no capital charge stipulation in the Basel I Accord, and the capital charge was prescribed because of the arbitrage between the capital charge for banking book and trading book. A lot of banks started moving their assets into the trading book. So that is the capital charge for the trading book was stipulated in Basel 1.5, that's in 1996. And we already have discussed the components of the trading book and the banking book. So today basically we'll try to understand what are the different risks in the banking trading book and what basically is market risk, how it is defined, what is the understanding of market risk, and what are the components and what are the parameters which result into the market risk. And one of the important measure of market risk, even the regulators do accept this measure for capital charge maintenance. So we talk about value at risk, and we also talk about the back testing of war models, and also a little bit about stress testing, and also to understand some of the risk mitigants as far as the market risk is concerned. Let us first understand the definition of the trading book. Trading book basically constitutes of the securities included under the held for trading category. We know that the securities can be put in three different categories. The first one is held to maturity. Basically the bank does not liquidate those securities till maturity, and they become part of the banking book. And the purely the securities which are held with an intention of trading, they are basically part of the held for trading. And another peculiar, which is more peculiar to India, is the available for sale category, which though earlier it was not considered for market risk, they are like a trading book as it comes to market risk computation. So it do form part of the trading book of the bank. Then open gold position. These open gold positions are subject to the have the risk of exposure to the change in the gold rates, which is very volatile. So the open gold position limits are again subject to the part of the trading book. Then again open forex limits, because banks are active in forex activity. They buy, sell currencies for them, for speculation or for customers. And there is always a back-to-back covering happens, but whatever leftover position, they are part of the trading book. And the banks do use a lot of derivatives, whether it is interest rate derivatives or exchange rate derivatives or credit derivatives, basically to hedge their positions in the banking book. But what you are talking about part of the trading book is those kind of positions which are basically part of the trading positions. And whatever derivatives, though they are done for hedging, but if you are done for hedging a risk in the trading book, they also form part of the trading book. So this basically constitutes our trading book. And when we are talking about market risk, we should be concentrating more on the impact of the market risk on all the positions which are holding. So now, what are the risks to the trading book of the bank? When we say this, the assets which are in the trading book are basically held with an intention of making a short-term gain by selling those assets whenever there is a positive or favorable price movement. Sometimes these positions are built up based on the expectation, so that if there is a possibility that equity prices are going to go up, possibly the bank would try to purchase some of the equity and hold it and sell off those equity when the price goes up and book profit. So is the gold or wherever it is permitted, and so is about the forex positions. Now basically the risk to the trading book per se are the market risks, which basically are due to the changes in the market prices of the assets which are held in the trading book. And then the another important factor which faces the trading book, because as we have said, basically the intention of holding a particular asset in the trading book is with an intention of selling those assets whenever there is a positive or favorable price movement. So the liquidity becomes a very important factor. So it doesn't make sense if you are holding an asset, it is the appreciation is happening, but you are not able to sell it in the market. So to book profit from the P&L perspective, you need to be able to sell those assets and book the profit. So basically the liquidity becomes an important part. So under the liquidity risk, the trading book again is subject to two kinds of risk. One is what is known as the asset liquidity risk, which is specific to the kind of asset or the bond which the bank is holding. Bank may have several kind of bonds, but if a particular kind of a bond or an investment is not liquid, then it is known as the asset specific or asset liquidity risk, which talks about the liquidity about that particular bond. And now generally there are scenarios wherein we would have seen that there is overall lack of liquidity in the market. When we say lack of liquidity in the market, it could be that not much of activity is happening in the market. So even the best traded stocks or the bonds sometimes would find no takers in the market because there is an overall shortage of liquidity in the market. So this phenomena is basically known as market liquidity risk, which is nothing to do with a particular security per se, but it is a kind of a situation which is prevailing in the overall market. And the third important one is the counterparty or credit risk. We know that whenever there is a deal, if a bank is buying, there is some seller. So if the bank is selling, there is some buyer. And it is always a two-way settlement. The bank which is buying a security has to pay the cash. A bank which is buying the one currency has to pay the other bank in the settlement currency. So basically, if there is a time gap between the settlement of the legs, every deal will have two legs, the purchase and sale. If it is a purchase for one party, it's a sale transaction for the other party. So if one party has completed his obligation and the other party is yet to complete his obligation, and if there is some problem with the other party, the first party who has honored his obligation will face what is known as a counterparty risk. So since banks hold securities and they hold derivatives positions on the counterparty banks, the trading book is also subject to credit or counterparty risk. Now the definition of the market risk itself. Market risk is defined as the chance of losses in portfolio value from market price fluctuations when required to liquidate a transaction. It is very important that though when I'm holding and I don't have an intention of selling it today, the liquidity may, it may be good, but the day the bank decides to liquidate a position, and if there is the prices come down, the bank is facing a market risk. So basically it comes out of the losses in the portfolio value from the market price fluctuation. Maybe on the day we decide to sell off, the market prices have come down. So this basically is the market risk. Now why do the value of the asset in the trading book changes? Because of the features which are attached to the instruments. The most of the instruments, financial instruments, either will have a characteristic which have an interest rate, either they will have a fixed rate, floating rate kind of thing, or they may be denominated in a foreign currency, or they may be related to the commodities, or they may be the equities. So all these assets, if they have all these kind of characteristics, and we know that the exchange rates are going to change, are volatile, and if you have a fixed interest rate investment, if the interest rate moves up and down, the value of the bond is going to go up and down. So that basically is because of the fluctuation in the interest rate, exchange rate, and commodity prices and equity prices. These are which causes the price fluctuation, or basically which are these are the risk factors which gives the market risk. And which are the instruments which are subject to the market risk? Any instrument wherein these risk factors exist. If you take about the fixed income products, the fixed income products, as the name suggests, have the fixed rate of interest. So any change in the rate of interest is a risk, and so it can affect the market price of that bond. And the same if the fixed income product is not a sovereign bond, but it is a private sector bond, so then a private corporate bond, then the same bond will get subject to again counterparty risk. And if the same fixed interest income bond is denominated in foreign currency, then again it is subject to the currency fluctuations. So basically the assets subject to the market risk will be the fixed income products. Basically the commodities, again we know the prices are very volatile. Currency is always the most volatile market, so that's again is subject to the market risk. Equity prices, we know that the kind of volatilities we have seen in the equity market. So very even intraday also there is a huge volatility in the market. So that becomes a risk factor as far as the equity is concerned. Derivatives held for trading, because the derivatives are basically derive their values from the underlying. So any change in the value of the underlying because of the risk factors which we discussed, like interest rate, exchange rate, commodity prices, and equity prices, will also impact the derivative prices. So the trading book also contains some of the derivative transactions which are done either with an intention of speculative in the derivative market itself, or sort of arbitrage in the derivative market and kind of an asset market in the trading book. So let us understand what is liquidity risk in the trading book. As we discussed briefly earlier, asset liquidity risk is basically specific asset facing a lack of liquidity. So this happens sometimes because the whole, some of the private sector bonds, the issue itself is very small, and probably one of the it's not very well diversified as far as the holding is concerned. So if it is not so diversified as far as the holding is concerned, there is a possibility that the particular bond may not trade that actively in the market. So whenever we have a position or we are holding on a large portion of the whole issue, probably we also may face the liquidity risk, because we will not be able to sell this specific bond because of the large chunk being with us, and there are not many takers in the market. So this is specific to the particular asset or the bond which you are holding, which is known as a asset liquidity risk. And market liquidity risk basically comes out of this general liquidity crunch in the market. And maybe in a worst scenario, it could so happen that we will not be able to even liquidate at whatever price. So if even we want to know that the particular asset is going to lose value, but the liquidity conditions are so tight, we may not be sell it at all. Whatever may be the price we are, or whatever may be the losses we are ready to take. This is an extreme scenario. Now about the credit and counterparty risk, we know that the bonds, debentures, commercial papers which are issued by the corporates are subject to credit risk, and even the sovereigns, if you are investing in the sovereign bonds of other than the home country, they are also subject to the credit risk, because all these bonds are traded based on the rating. So all these other than the sovereigns are subject to the credit risk, whether it is in the banking book or in the trading book. So what is the indicator of the credit risk? One of the important parameter which is considered for particularly in the trading book at the time of considering for investment is the rating, external rating of the bond or the debenture. So if you have a AAA rated bond, basically it helps a lot in the sense mostly the top rated bonds always have a good liquidity in the market and also have a lesser credit or counterparty risk. Derivative like interest rate swaps, basically which are the over the counter instruments, they have the counterparty risk because the settlement has to come from the person who has written the contract. Unlike in case of exchange traded contract, ETC contracts, where the central counterparty takes care of the settlement risk. So you are not exposed to the counterparty risk as in the case of OTC products. Now broadly the organization structure for managing a market risk management function, it is again, as we know that the risk management function is board driven. See on the top, board of directors basically will set up all the, approve the policies which are required to contain the market risk in the bank. Next is the subcommittee of the board, which is the risk management committee of the board. And then one important division which takes care of the market risk in the bank is what is known as asset liability management committee. Some of the banks have separate market risk committees, but predominantly in most of the banks, the asset liability management committee also addresses the market risk function. There is an additional support group, basically which does sort of a analysis, market analysis. The support group will have economists who understand the market very well and prepare necessary research report for the front office. The important department which really takes control of the market risk in a treasury or the trading activity of the bank is what is known as the middle office. We know that in the treasury there is a front office who deals with the market, back office which basically handles the settlements. Middle office is the one who takes care of the various risk limits set up by the bank to monitor and control the market risk. Now let us talk about how do you identify the market risk in an instrument. One unit which will get involved before rolling out any products. So basically it is known as a product group which goes through all kind of risk based on the risk factors what we discuss now, because we know that the market risk comes out of various risk factors like interest rate risk, exchange rate, equity risk. So this, any product needs to be analyzed whether it has any of these features. And also we need to set up proper stop loss limits. When we say that we are going to deal with a particular kind of a instrument in the trading book, the first thing is to decide what is the kind of limits we are looking for, whether it is deal size or from the stop loss. And then OTC derivatives, when you are dealing, they are also exposed to the counterparty risk. So we need to set up counterparty limits when you are dealing with the OTC derivatives. Exchange traded contract derivatives are of course not subject to the counterparty risk, but when you are dealing with any of the the products in the market like derivatives or any product which has the risk factors which we discussed earlier, it will always have the exchange risk, though it is dealt in the exchange ETC, but it will not be subject to the counterparty risk. So like if you have given a loan in out of FCNR funds, it has an interest rate risk and liquidity risk if we are not matched the securities. But since we are giving the loan out of our own FCNR funds, probably it will not be subject to the exchange risk. Open forex positions is another area which is subject to the exchange risk. So it is a position which needs to be tracked and monitored for controlling the market risk. Forex forward gaps, basically they are not exposed to the exchange risk per se. Exchange risk is only to the extent of net open position, but we know that the forward rates are functions of interest rates. If we have forward gaps in the forex position, it is subject to the interest rate risk, because the forward rates will get changed with change of interest rate of one of the interest rate of the currency pair. Suppose you are talking about USD INR gaps. If there is change in the INR rate, probably the forward rates will go. It will change, and probably it will have an impact on the valuation of the gap. Each of these factors like interest rate, exchange rate, if the bond is a fixed rate bond, it is sensitive to the movement in the interest rate. So fixed rate bonds are sensitive to the interest rate movements. Exchange rate movement, if a bond is denominated in foreign currency, it is again the value of the bond will be linked to the exchange rate. So the sensitivity comes from the exchange rate movement as well. So basically, to capture the market risk, we need to know what is the price sensitivity, how much the instrument or the asset is sensitive to a particular risk factor, and what is the degree of movement in the risk factor. So how far the exchange rate has moved, whether it has moved by 20 paisa, 10 paisa, or if it is a fixed rate in bond, we should know what is the movement in the interest rate, whether it is a quarter 25 basis points or the 50 basis points or 100 basis points. Or the next important thing is the probability. What is the chance of such a movement? So when we multiply the market value of the current exposure in rupees with price sensitivity, and when you further multiply this with degree of movement in the risk factor, like whatever movement has taken place, and with the probability, we will be able to measure the market risk. So what is important is, irrespective of what is the instrument, whether it is a bond or equity, as far as the market risk measurement is concerned, how vulnerable the current exposure is to the movement in the risk factors. We know the risk factors comes out of interest rate, exchange rate, commodity prices, equity prices. If you want to measure the market risk for a particular position, we need to know how vulnerable the particular kind of exposure is to these different kind of risk factors. Then probably if you know the price sensitivity and the degree of movement in that particular risk factor and the probability, probably will be able to quantify the market risk. And simpler techniques just take only one factor, price sensitivity. Just if you are talking about a fixed rate bond, we just have to know that suppose there is a movement of 1% of interest rate, how much value of the bond is going to go up or down. And advanced techniques also consider the other factor, the probability and correlation across different products.